You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Boot Camp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. If you trade options, you've got to ask yourself, why would you choose an options trading platform that puts investors first? At public.com, there are no commissions or per contract fees. And more importantly, it's the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So, don't change your strategy, change your platform, and see the difference in your bottom line. No commissions, no per contract fees, and it's the only options trading platform where you can earn a rebate on every contract traded. To learn more, please visit public.com/optionsbootcamp. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody. That music means it's one of my favorite days of the week. It is Education Wednesday time once again for a little taste of the old OBC. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network that is growing by leaps and bounds, seemingly week in, week out. Hope you enjoyed the taste of the newest addition to the network last week, the Futures Rundown. So all of you out there listening to this show, you're dipping your toes into options, want to learn about options. Very much a sister show there. We talk about futures trading activity, but also there's a healthy educational component over there as well. What the hell are futures? How does that margin thing work on the futures? What's a tick size? How do you analyze and determine the contract value, the notional value, all these things that are kind of lost in the murky weeds. Why is future symbology so ridiculous? All types of things we'll get to on that show. If you liked it last week, you can get a double dose of it this week, because immediately after the shows today, we're doing a double header of boot camp, so our pro friends will get a double dose already. Immediately after that double dose, you get the double dose of the Futures Rundown with the other Dan the Man Gramza, joining me on that one in a little bit. So back-to-back double Dan doses on the network today. So hopefully you're enjoying that. If you are enjoying it, feel free to leave a review on whatever platform you're getting it on. This week, we have Eric Zibick coming out of iTunes, looks like. He says, awesome, 5 stars, easily digestible, relevant, and current options information. Wow. Well, thank you very much, Eric. And joining me on the show wouldn't be the old OBC without the black-hatted one himself. What our listeners call, what they call you, Sergeant Passy? Yeah, Sergeant Passy, a.k.a. the little birdie tells me the newest star of the wide world of options. Mr. Dan Passarelli. Mr. P, welcome back to the show, sir.
Oh, yeah, man. Great to be here.
So you didn't have enough time on the network with OBC. You had to go worm your way into a little wide world of options with the OIC as well, sir, huh?
Special invitation, my friend. Special invitation.
Well, listeners, if you want more Dan in your live, stay tuned for that. That should be hitting the network next month. That is a monthly show here on the network with the folks over there at OIC. And you could hear Dan's musings on all sorts of things, indeed, covering the wide world of options as we keep on rolling into the wide world of options drills.
Holy mooch! Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to some options drills where we explore how to utilize some options techniques or tips or tricks in your own portfolio, how the pros like to do things. And this week it was inspired by a question we received a little while ago, a few episodes back, by a regular listener, OP Surfer. And I guess he's just the options surfer, OP Surfer. And he had a bunch of suggestions and requests for topics for episodes. We touched on a few of the other ones he had in the past, but one of the first one he asked for was trading in IRAs, the best option strategies to grow wealth in bullish, neutral, and bearish markets with consistency and reliability. Well, we're all about consistency and reliability over here on the old program. We touched on trading in IRAs many times on this show, so we're not going to go deep into the IRA aspect. We just did it very recently, I think, so go into the archives if you want to see that. But spoiler alert, at the end of the day, IRAs, no naked short legs, and you should be pretty good on most of the strategies that you want to do out there. All right, Dan, let's dive into some of these. Let's go in order. He asked for the best option strategies to grow wealth in the bullish, neutral, and bearish market. Let's start with the bullish. I organized this, Dan, into a couple of different categories. I call them first the obvious ones. So the obvious trades you're going to make in the bullish market, and then maybe some less obvious trades that maybe you might still want to think about, and then a few that maybe you want to avoid in a bullish market. So let's start there, Dan. When I tell you, man, it's a raging, it's a go-go bull market, or maybe even a middling bull market, what to you are the obvious trades you want to employ?
Well, I mean, the obvious ones to me are not necessarily the best ones. The obvious ones are, bull market, buy calls, which have their place and they work, especially with like mini trends, which I've been looking at a lot lately. So it becomes pretty situational, but to be like really consistent in like just like a steady bullish market environment, not one like we have now where we're getting a lot of mini trends. I like debit spreads, man. Just call debit spreads. There's one. Poor man's covered call is another one. Those I look at as more consistent wealth building activities rather than situational trades.
Yeah, speaking of situation, look, we're whipsawing all over the place today, huh? Starting out hot, vol spiking, and then turning right around, Dan. So another one of those days where don't like the market, just wait 5 minutes, Mr. Dan, which again, so this scenario for a bull market doesn't really apply to what we're living in right now, listeners. But of course, many of you come in weeks, months, many years down the road. So we love you all out there. And you're right, Dan, the obvious stuff, people say, oh, bull market, I'm going to go buy a call or maybe a call vertical. And that is kind of the obvious choice. We're not really breaking the rule book by telling you that one. As Dad mentioned, though, those, especially when you're buying premium, it really helps for you to have a more aggressive bull market. If you have a kind of middling bull market, or even a market like we're in right now where we rally a little bit, then we fade, then we rally a little bit, then we sell off, those types of aggressive directional strategies are not really going to suit you that well. Either that or you really have to be very quick on the trigger finger. If you're going to buy verticals, if you're going to buy out-of-the-money calls in a, let's say, whipsaw-y type market like we're in right now, then you're going to have to take your run, monetize it, get the heck out of Dodge, wait for the whipsaw to happen. So again, it very much is conditional. It very much depends on the type of bull market, but that's kind of the obvious thing, with the caveat that you need a pretty aggressive bull market to really have those pay off. Let's get to some of the meat, some of the less obvious stuff. Dan hit on one of them already. And again, this doesn't leap to mind for everybody right away, but it's a great strategy in these types of environments. It's the in the money call or the stock substitution type play. So you have a stock you think is going to run. You don't want to shell out the full cost to buy the stock, or best case 50% margin. You want to do a little bit better than that. You want to put the Greeks in your favor. You want to have delta working for you. You want to have gamma working for you. So if it worse comes to pass and it drops, you're not losing as much money. You want to have vol working for you. All the good things about the Greeks, all the good things that options bring to the table. At the end of the day, you want to have them working for you. Then the in-the-money call or the stock substitution. If you want to juice it up, you can go the overbee route of the fig leaf, aka buying a longer term, 6 months, a year, somewhere in that time frame. In the money call, let's talk 70 delta, roughly 75 delta, maybe 80 delta, and then turn around and sell whatever you want, weekly, monthly, out of the money calls against it. Now you're paying for some of that, and that's a great strategy for that type of environment. Not a huge outlay, and you're defraying it even more by just writing all those calls on a regular basis against it. So that's a great one that doesn't really jump to mind for a lot of people out there. Now, the caveat is you should be okay. In fact, I've talked to a lot of brokers specifically about this. It is going to be situational on whether you could sell, because you're not covered. It's a synthetic covered call. So a poor man's covered call. So it's situational with the broker whether they'll let you do that in an IRA or not. So your mileage may vary there, but you can definitely do the in-the-money call part. Also, some other ones that are less obvious but can be bangers, especially if you have the aforementioned aggressive bull market, are some of the ratio type verticals where you're not talking buying one and selling two or three. That's net short units. We don't want to go that route. We're going the other way. We're going net long units. We're selling one, let's say at the money, slightly out of the money call, and then we're buying two or three or more farther out of the money calls. You see this a lot in the VIX complex, but it can be applied to any underlying if it's a rocket ship to the moon at the end of the day. And that will, of course, allow you to have nominal outlay, keep your table stakes, keep your skin in the game. If it is a little bit of a whipsawy market, or if the bull market turns out to not be that aggressive, hey, you got this one. You didn't really pay a lot. Maybe you paid nothing. Maybe you got a credit to do that spread. So you can do those for a much longer time frame. Dan, what are your thoughts on either of those? In the money call, doing the fig leaf, what are your thoughts on doing that in an IRA? I think you can get away with that short call leg. And then also ratio vertical, sir.
Yeah. I look at those as distinctly different scenarios, or I guess I should say different market setups. And each of them has their place. I mean, I would say, and actually, I would say that the poor man's covered call is one of those where, you know, when you first said the title of what this show is going to be, or the concept of what the show is going to be, up, down, or neutral markets, one of the things that kind of crept into my mind for a second is, oh yeah, we could talk about strategies that work in up, down, or neutral markets, like the same strategy. And that is one of those things about the poor man's covered call, and the covered call itself, is that if we talk about wealth building as opposed to trading and making money, which are kind of slightly different things, you can end up benefiting, obviously, in up markets, because the poor man's covered call is a positive delta, but neutral markets as well, because you're getting theta. And down markets, yeah, you can lose on those, but we always have a hard time always perfectly timing things. And so for the times when the market goes down, sure, you lose, but you lose less. And so to me, that's one of those strategies that just, it benefits in kind of all market conditions.
A few others here on the less obvious side. Butterflies can be popular. Again, this is very much subjective and context driven. If the market is ripping to the upside, fly probably not going to work out. It's going to be hard to hit that bullseye. If you're going to do a fly in a ripping bull market, you probably want to do the skip strike, what we talked about before, the broken wing. Give yourself a little bit of extra room to run out there so that if you miss your bullseye, and you are going to miss your bullseye, let's face it, very rarely do you hit your bullseye with the butterfly, then you still can make some money on that. These symmetrical flies are for the birds in a rip-roaring bull market. And then some strategies to avoid. In general, we've been kind of, except for recently, Dan was talking up straddles. In general, straddles are a rough road to go down for retail. I'm talking straight long straddle, go in, buy the at-the-money straddle, and let the dice fly. That's a challenging thing. We've said it a million times. Back when we were market makers, we used to have those types of positions on. We could defend them by scalping our gamma. You can't do that as a retail trader. So that makes one of the best ways to defend a long straddle kind of out the window for you. So it makes it doubly dangerous, doubly difficult to make money on that. Now, if you're talking a rip-roaring market, explode into the upside, Q1 of 2021, everything's just exploding higher, yeah, you can go out and buy straddles in that environment. In fact, that's one of the few times I think you heard people on this network really heartily recommending straddles. Dan was talking about them, Brian Overby, we were talking about long straddles all the time. That's a good sign that that's a crazy market. Those are very situational. You need a rip-roaring, face-melting bull market to be out there buying straddles. Otherwise, stay away from them, or for the love of God, at the very least, you should always be doing this. Do them risk mitigated. Do the iron butterfly instead. Sell the strangle out of the money against it. Don't get run over just by a death by 1,000 cuts because nothing happens after you buy this ridiculously expensive straddle. Same thing with flies. Those are hard. The market's ripping. If you're kind of gently drifting up, a fly can be a great trade because it takes time to get to that bullseye. You want, especially the long fly, you want that decay to set in. You want it to widen out a little bit. You need a little time for those. The rip-roaring fly, a little bit more challenging. Dan, what are your thoughts on those? Any other strategies you think people should stay away from in a bull market?
Yeah, like one of the big challenges is when there's two things you can do with options, right? You can buy them or sell them. And a lot has to do with the velocity of said bull market. When we have those like nice, fun little grinding higher, I love just selling some option premium, taking in a little extra, everything's cool and copacetic. When you get those really, really aggressive bull markets, you really want to stay away from, flies and that kind of thing. And, it's easy to backpedal because as far as like trades go, directional butterflies can be really amazing, but I'm talking neutral butterflies here. You want to be really careful with those option selling strategies when the more volatility that the market is actually experiencing. And we tend to want to do some of those ones that we talked about earlier, in the money call, et cetera, et cetera. And basically the best way to think about it is, this is a phrase that I used to just say all the time. When you're buying options, you're buying volatility. When you're selling options, you're selling volatility. And I mean that in like a literal and figurative way. You want volatility to increase, be high when you're long options. You want volatility to decrease or be low when you sell options.
All right, let's keep rolling. We sunk our teeth really into the bull markets. Maybe we'll speed up a little bit here for neutral markets. We got to get 2 episodes in today, listeners. Neutral markets, again, the obvious stuff is going to be your short premium strategies, your credit spreads like we were talking about earlier, all the premium stuff. Dan was just talking about the covered calls, the short puts, all your typical premium harvesting strategies going to be the obvious go-to in a kind of neutral drifting kind of range bound market. And again, the good news, it's an IRA, but you can still do all that stuff. A couple of caveats. You can't have any naked short legs, obviously. And so for the short put, you have to just have it be a cash secured put. Again, we talked about that a million times in the past. As long as you have the capital to sell the put, you should be fine. Less obvious stuff. It goes against the grain sometimes, but you can buy premium. in a neutral market. Again, it has to be a very particular type of market, and that goes maybe to more what I was saying of the latter, the range-bound type market. If you can identify some ranges where you're comfortable, I think it's kind of topping out here. It's going to revert, going to go back down to this level, then maybe revert again. Obviously, premium buying can work well in that environment. Maybe you're a pretty aggressive technical trader, somewhere along those lines. You can do well in those types of neutral markets. Other less obvious strategies that we talk about on other shows, a little bit more advanced maybe, but something very, very much worth considering for you folks out there, are the volatility or the VIX erosion strategies. They do well in a neutral market where the market's kind of gently drifting, not doing much. Guess what's happening? Vol is typically coming in and can be coming in fairly aggressively during those periods. So any of those types of strategies we talked about before to play on that vol erosion can work in this environment. So, for example, you could buy puts in VIX. That's a pretty straightforward one. You could buy puts in some of the vol ETPs like the UVIXs or VXXs or UVXY, all various flavor of Franken products out there, levered, all kinds of stuff. You could buy calls in SVIX. Remember, that's an inverse product. And a bit of a caveat with that one as well. Some brokers don't play nicely with SVIX in particular, inverse vol. You need to have a high level of options approval just to straight buy calls on it. Ask me how I know that. I was looking at, we have a variety of accounts, obviously, including IRAs and different brokers. And I was recently trying to buy SVIX calls in one of them, and it got kicked. And I realized that particular account, for whatever reason, I think it was only options level 1. And that broker would not let you even just straight buy SVIX calls with just a level 1 account. So again, your mileage may vary on some of these vol ETP strategies, but they all can work in neutral markets. Dan, what are your thoughts on the obvious premium, or I should say neutral market strategies, and also some of my less obvious ones?
Yeah, I I don't like to compliment you, Mark, but I think you made some really good points there.
I know that's hard for you, Dan, so well done.
Yeah, I mean, my head usually goes to short gamma, positive theta strategies, those option selling ones where we're just making money by the stock not going through the short strike or through the break evens, if we're talking butterfly or something like that. But yeah, there is definitely a place for long options as well, just playing that oscillation, which is actually something that I've been talking about in, some complimentary trainings to our people this whole week. I call it the red knockout / green knockout, where we just, we play these little mini trends, and gosh, man, this is like the perfect market for that sort of thing. Just getting in on some calls when the thing sets up, take your profit, get in on some puts when the other thing sets up, the GKO sets up, take your profits. It's, it is something that I think a lot of people don't think about in neutral markets, but it can work great.
And just some things to avoid, don't go crazy selling the premium. I know it might be, this is the dead market. I'm going to blast away, going back to my old favorite, blast away on some at-the-money straddles. Again, don't do that. If you are going to do that, do it in a risk-mitigated fashion. Do the iron fly, buy the strangle against it, protect yourself. Don't go crazy. Again, no net short units. And guess what the short at-the-money straddle is? It's the mother of all net short units. You're short everywhere. So don't do that, listeners, at the end of the day. And also, this is IRA we're talking about. You can't do that in an IRA anyway. So don't do that. I wag my finger at you out there. All right, let's keep rolling on to the bear markets. Man, time's flying when we're having fun out there. Let's go to bear markets now. And again, this is going to be situational. Depends on the velocity of said bear market. But, the obvious stuff is going to be the opposite of what we talked about with the bull market, right? So you're going to go directionally in the other direction, long put spreads, short call verticals, anything that kind of fades in the direction to the downside. Dan, when I tell you bear market, well, what leaps to mind, sir?
Well, bear markets tend to have more force than up markets, statistically, on average. And so what really comes to mind there actually is just going and buying a put, because like I said, you're buying options, you're buying volatility, and that more forceful, more volatile move that can happen to the downside, just going and buying a plain old put is the first thing that comes to mind for sure, before I go in and better try and assess the situation and sort of maximize the opportunity for myself.
All right, some of the less obvious strats. selling premium, selling puts. You might say, well, it's a bear market. What am I doing? Stepping in front of that. Again, this is situational. If it's a face melting 3-4% a day, God knows when the bottom is going to be found kind of market. No, don't step in front of that. But if you're talking more of a grindy downside market, a great example, a recent example, 2022, kind of a grindy downside market. If you bought puts in that market in the major indices, S&P, you kind of got run over. You paid a lot for them. The skew was high, the vol was high, and they didn't perform that well because you ended up grinding down. Maybe you didn't even get to your strike, or you got there but took a long time to get there and your put was dead by that point. So in those environments, selling puts can actually be a great strategy. If the juice is worth the squeeze, if they're paying you a lot, a skew is high, and you're still just gently grinding down to that strike, guess what? You're going to make money selling that put. And if you get the stock put to you, if you've identified a level that you're okay buying the underlying anyway, then it's kind of a win-win. So again, don't dive in front of the 3-4% meltdown, but selling premium in those environments can be good. Other less thought of strategies, talked about them before, talked about them a lot on our Advisors Option Show. Collars and risk reversals. These are great. If you're long equity, maybe you don't want to sell it, you can always collar it, buy the out-of-the-money put, and then you're selling an out-of-the-money call against it. Now you're getting a little bit more income for that put. If you did it in underlyings like the Russell 2000 a month ago, you got paid for that collar, which is crazy. Not a very normal scenario, listeners. But a collar or risk, just a straight bearish risk reversal, buying put, selling call, that can also work pretty well in that environment. Again, for the kind of more face melty type of environments. And then going back to what we were talking about before on the vol front, going the other way, going long vol, obviously can be well. If it gets back to the scenario Dan was saying, if it's an aggressive downside bear market, guess what also is having an aggressive market? Volatility. Vol is popping. So you can go straight long VIX calls. They're going to be pricey, but in an explosive, like we saw on August 5th, upside market, VIX calls are going to work pretty well. If VIX can do one thing, it is outperform to the upside. And you want to be in there when that happens. Now, it only happens a few times, maybe a year, maybe a few times every couple of years, but you got to be in there when it happens. So that's a good time to be looking at long VIX upside. You can go VIX verticals as well. The ratio verticals we were talking about earlier, very popular, work very well in VIX. Selling 1, buying 2 farther out of the money, buying 3 farther out of the money. VIX is almost like the product that was designed for that type of trade. So if you want to be able to manage your table stakes, not pay a lot until you get that explosion, the short 1, long 2, short 1, long 3 vertical in the call side, great way to go in VIX. Dan, what are your thoughts on that? Collars and even selling premium, selling puts in a bear market, and then also going the long vol route.
Yeah. As far as selling puts in bear markets, I love it. And it's funny, every time I do a video on that or some sort of post, there's always some troll saying, oh, what are you, stupid? You're selling puts in a down market? You're dumb. But that can be some of the best times to do it because you get just that juicy premium. And when I do, I hope to get a sign because it ends up being a long-term play. And then, one other one that you didn't mention, I don't think, is, and this is true for bull markets as well, but I think more about them for bear markets because they can be a little trickier because there's a little bit more force to them. Are those directional butterflies where you risk very, very little, but if it hits, you can really make a very substantial profit. And I like those because, you just get such a better risk reward ratio, and some of them aren't going to work out for sure, but the ones that do can way more than make up for the ones that don't.
Man, time flies. I hope that answers your question, Hopi Surfer. We spent a full episode on it, but it was a great question. Another caveat, just again, be careful with the long puts in the bear markets. I mean, it leaps to mind. It's the obvious trade. It's the first one we mentioned. It's everyone's first thought in a bear market. But again, if you need a recent reminder, go back and look at some charts from 2022. Look at the sell-off, look how it played out, and look at some put prices early in the year and how they played out, what strikes we even got to. Buying puts was that you heard a lot of complaints from our listeners. Oh my God, I got run over buying these puts, and it was a down year. So just be very careful running out and paying any price for protection in the bear market scenario. Mr. Dan, that was a fun episode. Man, we packed a lot of living in here. We got to keep rolling with episode 2 of our doubleheader. But before we go, any final thoughts you have on any of these market scenarios we discussed? And B, if folks want to hear more from you, where should they go? What should they do?
Head over to markettaker.com. We're actually, the rest of this week, we're going to do 1 or 2 more trainings on those mini trends that are so great for this market that we're in right now. And, join our list, and we'll send you out an email invite to that event.
All right, you know where to go if you want to keep supporting the show. Let them know. Public.com. They have a special URL for you folks now. Public.com/optionsbootcamp. So just go to that URL. It's all you have to do if you want to kick the tires and light the fires. Sign up, kick the tires, whatever you feel like doing. They're already enjoying what they're hearing from you folks. In fact, they've already asked to stay on the show and renew. So they're clearly liking the feedback they're getting from you folks. It's a great way for you folks to continue to support the show. And it literally costs you nothing. Public.com/optionsbootcamp. Kick the tires on the rebate. Let them know what you like about the platform. Maybe let them know, even more valuable, what you'd like to see them add. And guess what? They'll probably add it. It's pretty cool. Public.com/optionsbootcamp, the place to go to learn more. We got to get on out of here, but don't worry if you're hanging out in the pro. I haven't even mentioned the pro today. TheOptionsInsider.com/pro is the place to go to get access to that. When you're in there, you'll get access to Options Bootcamp Episode 2 right now. Otherwise, you got to wait a week. See you back here next week, another episode of OBC. Stay safe out there, everybody.
If you trade options, you've got to ask yourself, why would you choose an options trading platform that puts investors first? At Public.com, there are no commissions or per contract fees. And more importantly, it's the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So, don't change your strategy, change your platform, and see the difference in your bottom line. No commissions, no per contract fees. And it's the only options trading platform where you can earn a rebate on every contract traded. To learn more, please visit public.com/optionsbootcamp. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.